Good day to everybody. This is Pranav Rao from Smartkarma's research team. I am pleased to introduce Sumeet Singh, the head of research at Aequitas Research, an independent research provider based here in Singapore. I will let Sumeet introduce his work in greater detail. So over to you, Sumeet.
Thank you for the introduction, Pranav, and thank you all for joining me today. A very good morning to all of you. I hope you can see my screen now. I've just shared it. So
Yes.
I'm here today.
All good.
Hello?
Yeah, all good.
Okay, great. I'm here today to talk to you a little bit about actionable ideas around IPOs and placements. But before I do that, I'd like to give you a quick introduction to us as a firm and what exactly we do, mainly because we don't quite fit into the ordinary definition of a standard research firm. So we were set up in 2014 as a part of Smartkarma. We are right now a four-member team based out of Singapore and Shanghai. We started covering IPOs and placements in late 2014, early 2015, and we kind of spun out of Smartkarma in September 2018 to form this company called Aequitas Research. What exactly do? We cover all IPOs and placements in emerging and developed APAC with a deal size of at least US $100 million. And the reason we have that restriction is because we cater only to institutional clients. So generally deals that are smaller than that are not of much interest to them. How do we actually cover it? So all of us in the team come from an equity research background. We've covered different sectors in our past across ASEAN, India, China. So we tend to start off almost all our coverage with a fundamental kind of bottom-up analysis on the IPOs and on the placements. But what we've done over the years is we've developed a quantitative framework which we also use to analyze each and every deal. And the reason we do that is not because we're a quant fund as such, but because we want to do a very objective analysis as well. So we have a set of about 60 odd factors in our placements and IPOs framework, which we kind of run every deal through to make sure that we look at each and every deal as objectively as possible. As the last point there in methodology, I say we're a fully independent firm because we're an employee-owned firm. We don't do any trading, we don't do any capital market activities. So in that sense, we are totally an unbiased view that you see. What you get from us is totally an unbiased view. In terms of our content, it's mostly research notes before the deal is launched, and we also tend to follow up and do the quantitative framework once the deal is live, and we follow up with ideas. This IPO is already through, placement is through, then there's lockup expiry, and like IPOs sometimes follow up into placements, etc. So we kind of follow the life cycle of the deal through as long as we can. What have we done till date? Very quickly, we've covered 463 IPOs till date, and we've covered 565 placements, all with a deal size above 100. There have obviously been a lot more happening in the region, but we don't cover the smaller ones. Hit rate in IPOs has been about 73%, and in placements about 66%. Very broadly, our hit rate we measure by if we say that you should participate in a deal and it trades well the first couple of days, we measure it to be correct. If we say you should avoid it and it breaks the deal price, we measure that as correct. Anything else in between is measured as wrong. Now, again, coming back to the point of independence, the last column says rated avoid. So we've rated 71% of the IPOs that we've covered as avoid. That kind of gives you an idea of how independent we are, because any research you get from a standard sell-side firm who's on the deal will always be to take the deal because they can't advise otherwise anyways. On placements, we're a little more positive. We've only rated about 33% avoid, with the rest being rated as take. Now, before I get into the actual ideas, there's one very quick overview of what has been happening in the ECM space for us so far. So these charts kind of speak for themselves, split it into the IPO and the placement chart. As you can see, the IPO bar has just like dropped off in 2020. So we've only covered about 15 odd deals, covered in the sense the ones that are actually in the process or have listed, not the ones that have filed but have not done anything about it. So there have only been about 14, 15 deals that we've covered so far this year versus almost 100 deals in each of the past 2 years. In contrast, on the placement side, we've almost covered about 60 placements so far this year, and we're not even through to the middle of the year. While on an average, we cover anywhere between 90 to 100 during the year. So the placements have been picking up a lot, mostly due to the rule changes down under in Australia, which allowed a lot of firms to raise this rescue capital. while the IPOs have kind of dropped off and only the bio names and the recurring revenue and the tech names are coming through. That also very selectively. So I'm going to start off and get to the actual presentation of ideas by looking at placements. Now, placements are a little tricky to look into because they tend to happen overnight and very fast. But what we try to do is we try to look out for placements that might come through, and that's kind of where we generate ideas for placements. So one of the ideas that we've been talking about for a month or two now is Budweiser Repack, which got listed in September 2019. To give you a little bit of a background, Bud APAC is owned by Anheuser-Busch InBev, ABI, which is listed in Europe and has ADRs in the US. ABI still owns about 87% of Bud APAC. Now, ABI in 2016 went and bought Sam Miller, and it took on more than $100 billion of debt on its balance sheet. It still has about $85 billion of that left, even after listing Bud APAC and selling off its Australian business. Recently, S&P downgraded it from AA to BBB, and they've kept it on negative watch. Even Moody's has kind of kept the company on negative watch. And as you can imagine, in a COVID world, their earnings have been dropping. So in 1Q20, they reported a 14% fall in EBITDA, while for the month of April, their volumes were tracking about 30% down. So 2Q is not going to be good either. Now the company, when it kind of spun out by APAC for its Hong Kong listing, had said that it's targeting to meet a 4 times EV/EBITDA ratio by the end of 2020. As of now, that doesn't look possible at all, unless there's a massive recovery into it, which is not looking feasible as of now. So what happens is they'll be under pressure to raise more cash to get down the debt if they want to keep their ratings. If they don't keep their ratings, they will be in a bit of a bind with $85 billion of debt outstanding. The last thing you want is to get classified in junk or anywhere near junk. So they have only two options in our view. Apart from obviously they've cut dividend a little bit in capex, but even that won't be enough. So their main two options are either to raise money themselves, which is either they undertake a placement for ABI, or they sell down some stake in Budweiser Repack. Now, the issue with raising money with ABI is it's trading at multi-year lows. It's actually at the same level as where it was in 2010, and it's about 70% off from its highs. So its shareholders are not going to be very happy unless they undertake a rights issue. What they could instead do is sell some stake in Budweiser APAC, which will kind of lift the overhang on Bud APAC as well, and it'll also act as a catalyst for the parent, and then they might be able to undertake a placement at the parent level as well. So we like the company when it listed. Bud APAC itself is a very good company. It's a premium name. Almost any beer that you drink of in the premium segment is owned by them, apart from probably Heineken. So that way, and it has very good margins compared to China Resource Beer and Tsingtao. While the stock has been underperforming since the start of the year, but as of now, to us, it looks to be attractively poised. So what we had actually put out a call was that maybe if you have the balance sheet, if you have the AUM, you should actually be reverse inquiring for a block here, because once the deal is actually done, it'll lift some of the overhang on both the stocks. So that was one idea. Since you put it out at the start of this month when they reported results, the stock has kind of performed a little bit better, but it's still underperforming its peers. So we'll see how that situation develops. When the deal actually comes itself, it should do well, primarily because it's already kind of factored in the share price. Now, my next idea on placement itself is again linked similarly to ABI. A bit of a very quick background in that. ABI in July 2019 sold their Australian business to Asahi. Now, Asahi at that time agreed to pay $11 billion US for that deal. And at the same time, it went out and said that they will raise about $2 billion of equity to part finance this deal. Now, this deal got delayed a little bit. It was supposed to close in the first quarter of 2020, but it got delayed because of regulatory approvals, which have now only come through, with the final approvals coming through on the 7th of May. And the deal is expected to close by 1st of June. Now, $2 billion for Asahi is more than 10% of its market cap. What we've been seeing is, we've again been tracking this for a couple of months, and what we've been seeing and what we saw with Asahi's results this quarter was that they kind of seem to be want to delay raising. So what they said was they'll put out a financial updates of the impact of the deal only with their 2Q results, which will probably be sometime in July or August. While what you would have actually wanted is the company to raise cash as and when the deal completes, which is around the 1st of June. Again, Asahi itself is on negative credit watch. It has been underperforming years. Even after placements, its gearing will still be quite high. So this remains an overhang for the stock. It has been underperforming its peers, as I said, for the better part of this year. More so Sapporo rather than Kirin since the last 2-3 months. We've been saying that you should be short the stock, and as a sector neutral, you should be long maybe a basket of Kirin and Sapporo, because Sapporo itself is a small market cap. But as and when the deal does get done, of course, in Japan, you can't use the deal to cover your shorts. But what we've seen with large Japanese deals is that when they do get launched, they tend to trade sideways or they tend to correct because the deals are open for a couple of days, maybe about 5 to 7 days, and that gives you enough time to cover. The deal itself should do well, as I said, because it'll be 7 to 8 days, and people already know that this is going to come. So it's kind of factored into the share price. So that's another placement overhang that we covered. Now moving on to the IPO side, as I said, there's not been much happening on the IPO space this year. But what has been the main driver and what we've been writing about since the start of the year, and I think one of the earlier panelists discussed as well in their talk, is the China ADR secondary listing. So we did a comprehensive study of this at the start of this year regarding the rules and who qualifies, who doesn't, because Alibaba kind of paved the way for other companies to follow when it listed in November 2019. So far, we've only seen 2 other names follow up, which is JD and NetEase. Now, both of them filed earlier this month at the end of last month. JD is again being touted to launch its deal probably in another 2 weeks. They're saying they're going to have an information hearing. They're going to have a hearing with HCX next week, so it should launch anytime after that. NetEase will follow. Now, what you try to do is you try to look at the various factors that are impacting the ADRs, and we classify them into the push and pull factors. Now, obviously, the push you kind of hear of every day in your front page news, which is Donald Trump or someone in his team ranting off about how China is not doing this right or that right, and obviously Luckin didn't help with that, and their accounting scandals over the past few years have been kind of adding up to it. Now, the pull factor is a little more interesting because Hong Kong and China kind of set this ball rolling in the last couple of years. China tried to get CDR off, which is Chinese depository receipts, off the ground by trying to attract these companies, but it hasn't really taken off. While what Hong Kong did was it kind of changed their rules on the weighted average voting rights, and it changed their rules for secondary listing, kind of make it more attractive for these firms to look at Hong Kong. So we kind of filtered through all the rules and we came up with a shortlist. We recently revised the shortlist to come up with 16 additional names that could potentially file maybe later this year or early next year. Now, to add to this, to these news of push and pull factors, yesterday evening, Hang Seng Index announced that they start including the secondary listings in the index as well. So Alibaba will probably go in, and JD and NetEase, as and when the list, will go in subsequently. In terms of the push factor, today morning I'm seeing news that NASDAQ is going to put in new restrictions for Chinese IPOs without explicitly calling it restrictions for Chinese IPOs. There will be restrictions on size and accounting, etc. So again, every day we have new pull and new push factors. Now the trade over here is because these filings are confidential, so it's not really, the timing of this is not very clear because like Baba took a couple of months to get listed, while you're seeing in the case of JD, it's been like 1 month going from filing to listing. But as you can see from the chart on the right side, JD and NetEase stock price, the one in blue, both of them have performed decently after announcing that they will be undertaking a secondary. So there's obviously no negative impact on the stocks as and when they do announce the secondary. Now the trading, once the deal is live, is another story, and we've kind of done a lot of work around that as well, where the ADR tends to flatline. At least for Baba, it did when the deal is ongoing, and it only tends to start performing once the deal finally gets done. The details of all of this are available on our different insights on Smartkarma. So in the interest of time, I will not go into a whole lot of detail about how the China ADRs trade, but you can contact me later and we can have a chat about that. Now, the second page kind of provides you the list of the names that we think might come through. There are a couple of reasons why we've shortlisted the name. JD and Etis obviously have already filed, but what we've done is we kind of looked at the performance of these names year to date, and plus we've kept some of the names that haven't performed well, but still their brands are big enough and good enough to kind of come through for a secondary despite the performance, those being Baidu and Trip.com. Now, one caveat for this list is some of the companies like Huya and Aichi and Bilibili listed in 2018. So they kind of the borderline of cutoff for being eligible, because according to Hong Kong secondary listing rules, you need to have 2 years of financial filing. So if you kind of use the 2 years of listing as a proxy, these companies are right on the borderline, but they will be eligible by the end of the year. And obviously, these stocks have been doing pretty well, especially Bilibili, since having listed. So they should come through as long as you keep seeing the push and pull factors playing, sooner or later, most of these names will come through. Now, the columns on the right-hand side provide you the actual deal sizes in terms of ADV, in terms of, market cap. So that's a 2%, 5%, 10%. If there is 5% of the market cap, which is kind of like the ballpark figure that JD and Neti seem to be heading towards, there will be at least a few deals which will be $1 billion in their secondary listing. But all of these names are spectacularly liquid. Even at 5% of the market cap, it's just about a couple of days of the ADV. So in terms of performance itself, it should not be that drastic impact on the stock performance or the ADRs. So this is the major trend that we're following this year, apart from the biotech and some of the tech listings and the real estate listings. Now, in terms of not so actionable ideas, but some IPOs that will come through later this year, hopefully, I put on a list. Obviously, you cannot do much in terms of trading with these names because they're not listed, but you can still try to get a meeting, line yourself up for hopefully getting some allocation in the IPO. So they are kind of actionable, not in the traditional sense of the word, but more so in the IPO sense of the word. The first name here is Nongfu Spring. Now, Nongfu's filed in April, so it probably won't come for at least another 2 or 3 months. The deal size is expected to be at least $1 billion. This is the market leader in packaged drinking water in China. Its earnings have been growing, revenue has been growing at about 17% CAGR for the past 3 years. It's been gaining market share in the drinking water. It's also diversified into other segments as well. It's doing tea now, it's doing functional beverages, and trying to diversify furthermore and build its own brands. We like the company because its margins are vastly superior to the listed names in the space in Hong Kong. The earnings are also pretty good and doing better than peers. And there doesn't seem to be anything particularly wrong in terms of corporate governance with the name. So this name should do well, probably somewhere down there, maybe another 1 or 2 months when it lists. The other name that is going to list probably in a month or two is Kanch Medical. It filed in March. The deal size is expected to be about $500 million. It's one of the leading domestic players in minimally invasive surgery devices. It makes disposable surgery devices, been gaining market share for the past 3 years. Revenues have tripled. Earnings have been good. It's moving up the cycle, and it has some reputable investors lined up as well. We've done a little bit of work on these names, and there's already insights available on Smartkarma on all of these. We will continue to follow up on these 2 names as well. Now, the 2 interesting names that could come this year, obviously the last one in the right-hand side corner, everyone should be familiar with, but that one is kind of a gray area whether it comes or not. VDoctor has already appointed banks. It's supposed to be $1 billion plus raising. It's online medical consultation backed by Tencent. From our analysis of the way the app works versus Ping and Good Doctor, which is already listed, what we can make out is VDoctor is much more focused on the online consultation space, on the actual connecting the doctors with the patient space, versus Ping An, which also tries to sell a lot of its e-commerce related, healthcare related goods on its platform. Now, obviously, it's not yet filed, so we don't have too much information in terms of financials, but this one should be an interesting one to look out for. Last but not the least, I put an indicated deal size for ByteDance there as 1 billion. It'll probably be much larger as and when it comes. Um, for those who don't know what the company is, it's the owner of TikTok, the app that probably 99% of you have heard of. It was globally the most downloaded app in the first couple of months. This year, I've been getting increasingly more and more forwards from the app in the last 2 years from around the world. So that kind of shows you how it's been picking up. It's been touted as a replacement for Baidu and the BAT for China. There's some financial information for the name out there. So we looked at that, and the earnings have been growing as well. They have a pretty good stronghold in the advertising market. They haven't filed anything officially. So as and when that comes, if it comes this year, that'll definitely be a very hot deal to look into. These are some of the IPOs that we've highlighted and we would want investors to look at. There's a whole laundry list of other names which are in the pipeline, but in the interest of time, and I will not go into that. I think I'm just about at the borderline of my time for talking, so I kind of will stop for Q&A here. Back to you.
Great, thank you so much, Sumeet. For attendees, just a heads up, you should see the Q&A tab at the bottom of your screen to send across questions. We've already got a couple through, so let me put those across. The first one's regarding your work on placements. Are there certain markets where you've not seen as many placements as you would have expected?
So the actual market this year where we've seen a whole host of placements is Australia. Like almost, I would say, half of our placements that we've done this year is Australia. We thought there'll be a lot more placements in Hong Kong as well, but that hasn't happened. Actually, there should have been a lot more placements across the sphere in even Singapore, even in India, in Hong Kong, in Japan. But for some reason, the regulators have not been as proactive in allowing the companies to do an emergency raising like Australia did, which kind of changed the limits and kind of gave the companies green light to go ahead. What we are seeing in the other markets is more just regular placement work, which is some company, some investor trying to sell off a block or some company raising for acquisition. But what we actually saw down under is companies coming up and saying, my revenue is literally going to zero for the next 2 months, and but I know it's going to come back, so I need $100 million to kind of survive for the next 6 months. And they've been able to come and do that, and this share price have reacted very well. Most of these rescue placements have done phenomenally well, apart from a handful which were not really rescue placements, but were trying to position themselves as rescue placements, and they didn't do pretty well. But the actual ones in travel and leisure, etc., which came, have done pretty decently.
Okay, cool. The next question is regarding the work you're doing on China ADRs coming back home effectively. Do you see the recent news flow, especially yesterday and today, meaning that we're going to see larger size secondaries? I know you put the ballpark at about 5%, yeah. But is it likely that these are potentially going to be bigger?
So that's a very interesting question, because what Hang Seng did yesterday was, it said that Baba would go into, it didn't say specifically Baba, it said secondary listings will go into the indices, but they'll only count the Hong Kong listed shares as the free float for inclusion. So instead of counting the $500 billion plus market cap of Baba, we'll only count the $13-15 billion worth of stock that's listed in Hong Kong. So that was, I would kind of say that's cheeky, because what it does is it incentivizes companies to go in for a bigger deal in Hong Kong if they want to get that passive flow down the road. But you also have to keep in mind that these changes are for the Hang Seng indices, and the rules that I know for Hang Seng, they don't include any listings for the first 6 months. So they will not impact the IPO deals themselves. So what happens is, it's only after the stock has been trading for a period of 6 months does it become eligible for going into the Hang Seng set of indices. So in that sense, it will not impact the deal price and the deal performance at the time of listing. It's obviously something that will happen down the road. It does incentivize these companies to kind of get a bigger chunk listed in Hong Kong, and we are seeing that more and more. But we also have to keep in mind that these companies already have a large set of shareholders in their ADRs. And if they try to do an outsized size deal in Hong Kong, and when most of these companies are actually already sitting on cash, they don't really have that much debt. it's going to end up impacting the ADR performance. So they all will be mindful of that. That's why 5% is kind of like a ballpark, which I think they can get away with without having too much impact on the ADR. If they try to do something more sizable without having, I would say, an outright plan of what they're going to do with the money, like Baba came and said, it's just raising money for general corporate purposes, right? JD as well is already net cash. It's also going to raise just for general corporate purposes. So if you come and dilute 10% of your market cap and you don't really have a plan of what to do with the money, I don't think your existing shareholders are going to be very happy. Having said that, the ADRs down the road will be fungible, so you can always divert that back to the HS, potentially to the conversion down the road.
Got it. And on the same front, what about the Stock Connect? Do you have an idea on what the rules are for inclusion into the Stock Connect?
So Baba, one of the reasons they listed in Hong Kong as per us was because they would go into the Stock Connect. But there's kind of a tussle going on from what we can see between Shanghai, Shenzhen, and Hong Kong. Hong Kong obviously wants Baba secondary to be included in the Stock Connect. And from the way we are reading it, it seems like Shanghai and Shenzhen don't, because what they've done recently is, and I wrote about it in my note last week, is they've lowered the limit, market cap limit for companies which can look to issue a CDR even to about $2 billion. It earlier used to be only $20 billion and above. And there's no news whatsoever on Baba getting included in the Stock Connect. At the time when Baba got listed, there was supposed to have been a consultation happening about it, and the results of the consultation are supposed to have been out now. But there've been absolute radio silence on it for the past couple of months. If it were to go into the Stock Connect, the consultation should have come out by now, and it would have been included in the Stock Connect coming in June. Because the rules of the Stock Connect say it can only go in after, I think, the proposed rules said it will only go in after 6 months and 20 days of trading. So Baba got listed in November, so it should have gone in somewhere in the end of June, but there's no clarity on that. And I'm guessing there's a little bit of politics going on in the background about whether Hong Kong should be incentivized or not for the secondary listing. Because if they don't allow it, then it's an additional reason for these companies to maybe undertake a CDR down the road. But if they actually allow the Stock Connect, then the CDR doesn't look that attractive anymore.
Got it. I think we might be able to squeeze one last question in. This is regarding accounting scandals. I know you've looked at GSX as well as Luckin. How do you try to work that kind of analysis into your work?
So luckily, in our team, I wasn't the one covering Luckin. So I kind of got away with, even though we were negative on the deal, but at least it wasn't me. But anyways, Zenzo has been the one covering it, and I think he's done a decent job of covering both of them. We try to look at the deals from a corporate governance angle as well. Obviously, it's not easy to pick it up every time, but there are certain red flags which are visible. Like I just spoke to you about Longfu Spring a couple of minutes back, which is coming to list. The company is great, everything looks perfect, but if you look into their financials, they're paying out about $2.5 billion of dividend before coming to list. Now that for us is always a red flag. Obviously they have the money, which is great. It's not like they're raising money to pay, they are raising debt to pay off the money. But if there are things like that, if there are things like the promoters having cross holdings or having related party transactions, we always, in our framework, we have a separate kind of category on which we rate these companies. And we sometimes catch these, like in Hong Kong, there are a lot of mid-tier stocks that come which have something or the other that's questionable. We've been able to catch most of these, but there are some that always kind of filter through because there's not enough disclosure. Like in Luckin's case, it was just a lack of disclosure, right? They were making up the numbers. Now, unless you go and actually do the on-the-ground verification of the numbers as the short sellers did, you don't really make out as much from just reading the prospectus. So from our point of view, the reason we have one member of our team in Shanghai is so that they can go and do a little bit of the on-the-ground checks at least. So our team member Mingru has been doing that for some of Luckin products. He went to the stores and he was also kind of negative that the numbers are too good for the lockdown. And we try to do more and more, especially with consumer-facing firms, as and when we get the chance.
Got it. I think that means we've hit time. Thank you so much for presenting today, Sumeet. And we will be back shortly for the next session. Thank you.
Thank you.